What's up, guys? Welcome back to day 14. I think this is part 2 of the day. I just finished my classes, so I'm gonna spend some time working on the write-up I have for one of my business classes, and if I have some time, try to do some of the extra credit stuff. But I think I left off on week 2B of my write-up, and this week our professor wants us to look at sovereign wealth funds, specifically the sovereign wealth fund in Norway. I believe it's called the Government Pension Fund Global. So this is a fund that can, I think, invest in public equities and fixed income markets with a little bit of real estate mixed in order to provide this kind of this national pension fund for the constituents and the citizens of Norway. And it's really funded by a lot of money that Norway has made via petroleum exports. I think Norway is maybe 6th or 5th in the world in terms of petroleum exports, and so it's been able to funnel a lot of the cash, a lot of the money that it's earned from that into this fund that's been reinvesting it at, I think it's a target of 4% real rate of return, so that's in excess of inflation for the next who knows how many years. So I think, let's see where we left off. There's a research paper that I think we need to read, and this talks about how the fund itself is set up, and then also what the structure looks like and how the strategies work within the fund itself. Yeah, so let's take a look. Responsible investments. Positive actions to the exercise of ownership rights, or negative actions by excluding certain companies. Okay. So it seems like Norway has chosen both an activist approach and a passive approach. So in the passive sense, okay, I guess from the passive, okay. So I'm thinking that from the passive approach, the government of Norway has compiled a list of companies that it believes should not be invested in. I think, one, because of the types of products they make. So within this list, there's companies that produce coal energy, there's also cannabis companies, and also companies that produce nuclear weapons. And then from the conduct approach, in the sense that these companies have had a history of employee misconduct or possibly environmental misconduct. Okay. Oh. And conduct ethics. Okay, so that's a big one. Okay, and then from the activist approach, Norway has some controlling interest in some of these companies that it's publicly invested in, and through that they've been able to vote on issues that it believes are pertinent within the company. And I think that's the biggest way that Norway has. Okay. First approach. Size things. Okay, yeah, I think this is the biggest thing. So they've had the ability to vote on important matters, and also they have a lot of influence on choosing board members that align with their interests and ethics. Okay. Okay, so that's a big caveat here. The actual participation in company, corporate management, and strategy seems like it's being done through active managers, external asset managers that that Norway hires. Okay, so it seems like the fund itself faced a period of pretty bad performance in 2007, 2008, probably due to a global financial crisis. So what do they mean by relative? Oh, relative might have been towards relative to the benchmark. Okay. Valued additional contribution. So these reports present as self-responses, public criticism, and fund performance. Moderate. Too moderate. Moderate. Too little risk instead of too much. Five 5.03%, benchmark return 4.71%, tracking error. Formation ratio, gross return minus inflation minus mean. Trained to be so small. The authors recommended that the fund shift its active management focus from bottom-up security towards top-down factor allocation. Okay. So public focus on quarterly performance measures and headline risk aversion reinforced by media scrutiny may induce short-termism and excess conservatism. I see. Strategy. The large losses during the financial crisis have been more than compensated by the gains made in the subsequent market upswings. One important reason is that we held on firmly to the long-term investment. Okay, so I guess their whole idea is because the Norwegian fund is kind of this really long-term solution, this long-term outlook, then there are more good times than bad times, and usually the returns from the good times outpace the returns from the bad times. And so with their investment philosophy, they don't really want to focus on short-termism or making more conservative trades or conservative investments because they think that it might negatively affect them in the short term. Yeah. And I guess with the media in Norway and a focus on the public focus on short-term performance, whether it's through quarterly reports or annual reports, the fund itself can face a lot of backlash, which it has to kind of deal with. Okay, let's see how many words this is. Exactly 300 words. Okay. Harvesting risk premia. What is a risk premia? From the non-return harvest premiums. The traditional approach to building investment portfolios has been a simple asset-based approach, with the building blocks being individual assets, such as stocks and bonds categories and groups based on instrument type, instrument replication. Okay. systematic part of portfolios. Value size and liquidity as returns or active styles of investments such as momentum strategies and carry trade. Okay, so beta, I guess, can also be thought of as a risk factor. More than 2/3 of the variations in the fund's excess return over its benchmark can be explained statistically by systematic risk factors. Recessions, financial crises, liquidity shortages, and so on. Academics still debate whether it's are determined by rational or by irrational behavior. Both sources of return probably. Sin stocks. Value premium is a long-run outperformance of value compared to the more richly valued peers. Okay. Risk premium from multiple sources. So, seems like what this thing is talking about is there's different types of premiums that exist within types of assets. There's three big ones that they talk about here. One is the size premium, the value premium, and then the liquidity premium. Value companies are companies that are traded at a lower price relative to their book value or their dividend value. And apparently they do better over the long term compared to growth stocks, companies that are highly valued. And then the second, the liquidity premium, is the idea that more liquid investments are able to outperform non-liquid investments. I'm not too sure how true that is. Okay, never mind. I switched that up there. That's why I said it wrong. I think the fact that company or assets that are less liquid, meaning that they have a lower ability to be able to turn into cash. They face a higher liquidity premium in the sense that they demand a higher return. And then the last one is the size premium. It seems like companies that are smaller market cap tend to have higher returns over the long run. It probably has to do with the greater risk of these smaller companies because they are, I think a lot of their value comes from getting bigger. And sometimes they can't do that. Pro-cyclical. Rebalancing has a contrarian flavor. Okay. It implies purchasing an asset class that has become cheaper while trimming holdings of an asset class that has outperformed. Nice. What is this strategy? Effectively sell protection against financial catastrophe includes selling equity, index volatility, and buying positive carry. Okay, what is carry? What is selling equity index volatility? its best managed fund.
Always one producer, okay? But that is much more efficient than FP3 because that one producer doesn't parse it, right? It just produces chunks. So all it's doing is getting the next chunk, right? And then the consumers, of which there are however many you ask for, consumers will pop the next chunk, parse it, and then iterate over the actual lines.
Rates it to strengthening its financial theory resource. This involves creating a global investment culture staffed with few personnel. The fund emphasizes roles of responsible investing. So it just seems like the Norway model is an alternative to David Swenson's Yale model, and the biggest difference lies between how the funds try to generate returns. In the Norway model, it seems like it's really trying to focus on generating returns by focusing on beta and risk premiums. So what that means is it's taking on more risk to generate higher returns over the long term, as returns tend to revert back to the mean. And so this means that even though the Norway model might take on greater risk by achieving higher levels of beta, then over the long term, this risk should kind of normalize, and the returns are able to fall in line with the consistent 4%. On the other hand, the Yale model, I believe David Swenson tries to capture these types of alpha in the private equity, venture capital, and absolute return spaces, mostly focusing on private equity and venture capital and infrastructure, so real assets. These are mostly illiquid assets that David Swenson tries to capture what these researchers call a liquidity premium. And so the liquidity premium is the idea that assets that are difficult to mark to market or to convert into cash, they have a premium or a higher return compared to assets like stocks or bonds that are traded on an exchange with an immediate price. And this could be because of the private nature of the assets. There might not be a lot of data to support the valuation, and also there might not be a lot of people within the market of looking to buy these businesses. So yeah, I think these are the main differences. Right.
I saw the submission, and I saw the file. It just got by.
And then private equity and real assets rates, okay. Okay, so what does this actually mean, right? Okay, so what I'm looking at here is Norway is betting on the idea of risk premiums, that taking on higher risk will give you higher return in the long term. While Yale, on the other hand, they're trying to capture excess return without taking as much risk. And in fresher markets like private equity. So, what I mean by this is that Norway seeking betting on risk.
But I'm not sure.
risk premiums like size, value,
Also,
and
well, I guess I'll look fine. Also, I more stuff. It's not directly comparable, but like, I think what we have to do is. Yeah. So I think it's important to state, I think it would be essentially the same kind of deal, like, it's very, like, it doesn't make sense, I think, to have more than one computer if you're not like,
size, value.
basically just doing that.
Yale's betting on
Yeah, if you're working with SSDs,
excess
yeah,
returns
then I guess,
for
and your chunks are fixed.
consistent risk, thin markets, most notable, biggest being private. Efficient markets.
I think also.
Hmm.
Well, parses, yeah, parses record by record. And so, the one thread from all of them, right? And just basically putting the
I think that's these models that Norway and Yale Okay, so how do we answer the second part of this question? Should Norway use the Yale model and should Yale use the Norway model? And just from kind of this face value point of view, I think that they shouldn't. And the reason is because Norway, their entire entity, a tyrant sovereign government, a sovereign nation, and their objectives of what they want to use these funds for are different compared to what Yale is. And there's also two different types of institutions here. One is a university and one is a country. And I think with the public markets, with fixed income and equities, it does give more transparency to what's the investment opportunities that a government is participating in. And and maybe possibly and maybe okay, and I think another thing we should add here is that the oil money, the petroleum money that Norway has, it is a strong source of cash flows that can help support the chase for risk premium. Okay, something along those lines. And Yale, on the other hand, they're a private institution. They have more leverage on what types of investments they can make, and they also have the connections and the prestige to it. Right.
We should also like, we should also
Also, I think within in the case of Yale,
honestly, that's the point.
they're
Yeah, because we run GG down.
their cash outflows may not be as consistent as right. So Yale's cash flows might not be as consistent as Norway's because if you think about it, Norway eventually they're just really a pension fund. I think how it works is at a certain time after they retire, then they receive payments from the government. On the other hand, Yale, the endowment fund, it's used to only supplies maybe a small portion of professors and faculty's salary, but I would think the most important uses are it's kind of like a rainy day fund that the office or that the university can use in case it faces some financial difficulties or if it really has a cool project it wants to implement. But those cash outflows probably aren't as consistent as the global pension fund. Okay. Pay out towards secrecy and secrets and qualities of private equity isn't suited for I think the secret secret
So one of the GZIP best key block, this is like maximally big maximum block, which is why again my GZIP checkpoint mission is really simple idea. But yeah, you've got one GZIP file. It's a stream. You have to start from the beginning. There are multi-threaded GZIP compressors, but the algorithms don't have Sunday, right? They try to predict what the statement does. It's like actually cloud
so it doesn't even have okay so as of today 2023 company the fund itself doesn't invest in private equity yet but it's asking if it should so there's that. Oh, I got a call from my parents, gotta take that real quick. isn't a great match. Okay, it's a big round sentence, but it's fine. Yale is a private institution and is free to do wants with little transparency, so the greater allocation towards secrets and liquid investments doesn't need to disclose to anything to the public and has much less capital consistent capital outflows. Makes more sense. Okay, that's pretty good. Purchase diversification, not through geographies. Purchase diversification through geographies. Europe, Asia, Americas, as opposed to supposed to. geography is really small. Hmm.
No, it's certainly true. I think it's more, but it's not like we just keep pumping up the right threads and keep satisfied. Really, and I think this also means that we're going to be highly dependent on internationals. Many threads will help in all the other phases, but the first phase is how fast we can compress. So using the fastest, Jesus.
No, that one. It is set.
You know, they're really good libraries. Well, it is by nature really it's not like really, Brian works, but it's really like it's way too well, so yeah, the thing is, there are already well, there are already schemes where you can do parallel compression if you have going compression. So like here's blockages in compressed files. A lot of files are available at Fortnite. In fact, BAM files are just blockages that compressed versions, binary versions of samples. Yeah, they carry a chunk. They're chunked, right? So like basically every so often you just restart the encoder refresh is completion, and there's a little text in the front that says here where my chunk boundaries are, and now you can jump to any position in the set of chunks and press that chunk. And so block which is compression just reflection if you don't have any information standing on boundaries.
Has incentivized active managers is with the performance incentives. Performance bonuses.
Many files at the same time, which is color,
appears Norway has little, has relatively low cost comes to fees towards investment managers. These, external and internal managers. Help Norway achieve its ESG standards by actively participating in board appointments, voting, reporting, list of companies. Okay. She objectives. Frustration. Providing future income to its citizens. Damn, I think I have too many words again. Shoot. Text being minimized.
Point is, if you rip out the parser, one, I guess you want to also ask. Ripping out the parser. Well, the point is, like, well, I don't
So how should the alpha cost of ESG investing theoretically be calculated?
Sub-private AMC, it's very difficult.
The alpha, okay, the alpha cost of ESG. So maybe this is saying, okay, can we compare a basket of companies that have a higher ESG score or possibly a higher perception of ESG compared to a broad-based index? So let's say the alpha cost of ESG is calculated by comparing baskets of ESG stocks versus a broad-based benchmark. Politics can be minimized. 453. Oh, shoot. I don't think I can have this many words. What the fuck? Okay. Alright. Let's see. Auto preview. So LS CD week to be Porto preview. What is this? Week to be QMD. WordCamp 429. Oh my god. Okay. File syllabus. no more than 200 words? Jeez. I really gotta reduce this. It can only be 200 words, so. Okay, it's good for now. I think I can continue. Okay. Yeah, I think I'm gonna. Okay, I think I'm gonna head out for now, but was able to make some progress on the next week's write-up, and I think there's gonna be another write-up for okay, private equity fundraising. Oh, you know what? Hasn't been posted yet. Alright. Yeah, it's good for now. I'm gonna sign off for a little bit and then probably continue a little bit later. Alright, see you guys.